Central bank just hits the brakes, and here's why. It's not because inflation is suddenly under control, and it's not because the global economy is strong. It's because something bigger just stepped in, something they can't control, and it's coming from outside the financial system. What happenings with Iran and the surge in energy prices tied to it is now forcing central banks around the world into a defensive position. Central banks around the world are starting to hit the brakes, and I mean hard. And the reasons isn't just inflations anymore. It's something bigger, something more unstable. It's geopolitics, especially what's happening with Iran and the ripple effects that are now spreading across the global economy. For months, the expectations was pretty straightforward. Central banks would gradually cut interest rates, ease financial conditions, and try to support growth. That was the plan. That was the narrative. But now, almost overnight, that entire outlook is shifting. Now you are seeing central banks from places like South Korea, India, Kenya, and even signal coming out of Europe, all stepping back, pausing, and even considering tightening again. And that's not random. That's a coordinated reactions to some things they can't control. Energy prices. Because here's the real issues. Oil prices are rising again, and it's not because of normal supplies and demand cycles, but because of instabilities in one of the most sensitive regions in the world. The situation involving Iran and the broader tensions around it are creating a supply shock that feedings directly into inflation. And once energy prices move, everything else follows. Transportations, manufacturings, foods, it all gets more expensive. So now central banks are stuck in a very uncomfortable position. On one hand, inflation is being pushed high again, which normally means you raise rates to control it. But on the other hand, higher rates slow down the economy, and growth is already fragile. So they're caught in these situations where any move they make has consequences. And you can actually see this playing out in real time. South Korea hold rates steady, but one, inflation could run harder than expected. India paused its rate cuts entirely. Kenya, after 10 straight rate reductions, suddenly stopped. That's not a coincidence, that's a signal. It's like they're all looking at the same problems and saying, we're not ready to ease anymore, not in this environment. And then you zoom out even further, it gets more serious. You got the International Monetary Fund stepping in, warning that global growth projections for 2026 might actually be downgraded. That's a big deal. That's not just short-term volatility, that's long-term concern. And when the IMF start talking like that, it usually means they're seeing something systemic, not just temporary noise. And let's talk about Europe for a second, because this is where things get even more complicated. The European Central Bank is dealing with what they call a double bind. And honestly, that's exactly what it is. Inflation is rising again because of energy, but at the same time, economic activities is weakening. So if they raise rates, they risk slowing growth even more. If they don't, inflation could spiral. There's no clean solution here. Even ECB's officials are starting to say out loud that rate hikes might be back on the table. And that's a massive shift from where things were just years ago. And then you look over at Japan and you see another layers of pressure building. Producer prices are rising faster than expected, driven heavily by energy costs. Oils and coal prices jump significantly, and that's feeding into manufacturing and supply chains across Asia. And here's something that stood out for me. The Strait of Hormuz. That's one of the most critical oil routes in the world. And disruptions there are being described as potentially the largest supply shock in the history of the global oil market. Think about that for a second. If that flow gets interrupted in any meaningful way, the impact isn't regional. It's global. So now you got these situations where central banks are not just reacting to inflation anymore. They're reacting to uncertainty. And uncertainty is much harder to manage. Because you can model inflation, you can model growth, but you can't easily model geopolitical tension, conflict risk, or supply disruptions that can escalate overnight. And that's why you're seeing this synchronized pause across multi-continents. It's not coordinated in traditional sense. It's sheer caution. Everyone is waiting. Everyone is watching. No one wants to make the wrong move in a situation that's changing this fast. And here's the parts that people really needs to pay attention to. This isn't just about interest rates. It's affecting everything. It affects borrowing costs. It affects housing markets. It's affecting business investment. It affects job growth. And ultimately, it affects everyday people trying to manage rising costs while dealing with an uncertainty economy. So when you hear that central banks are pausing or halting rate cuts, it might sound technical, but what it really means is that the global economy just got a lot more fragile. And with ceasefires talkings between the United States and Iran still uncertain, there's no clear solution in sight, which means this pressure, these tensions, it's not going away anytime soon. So the real question now becomes, how long can central banks hold this position before something breaks? Because they can't stay in this defensive stance forever. And that's where things starts to get unpredictable.